At the end of this video, you're going to understand why large amounts of volume often come into the market when trades break certain levels. Hi traders, it's Bruce Banks here, and we're talking about volume spikes down or up when previous levels are broken, and why that happens, and how you can even possibly trade this. So we're looking at a chart right now, and we can see that on this bar right here, we have a high amount of volume coming into the market when this breaks down. Now, this can be a combination of factors. So we both see at the bottom here, because we have the volume enabled, it's a large volume spike on this bar, and this bar makes a large price move downwards. Now, we have to look back a little bit to understand this a bit more. So I'm going to zoom back, and you can see what we have is we have consecutive days where, say we take these, we don't even look at the individual bars in these days. We're just going to take them for what they are. Look at one day here, another day, we have a higher high that day and a higher low. And the next day, again, we get a higher high and a higher low. We get another day, higher high, higher low. Higher high, higher low. This is the weekend here. Another day, even a higher high and a higher low. So what this is doing is building momentum. You have to take a look at this market from the perspective of the trader that entered on one of the day 1 or day 2, day 3, day 4, day 5. Any of the days, or even day 6, any of the days prior, you have to take a look at the market and think, well, what are the traders there doing and thinking? Because you're making trades against them. And so you have to think of their mindset. So let's take a trader who entered in on day 1. It's going great for him. The next day, he gets a higher high and a higher low on the day. He knows he's in that trade. He might even be holding that trade for a while longer. The next day, it gets another high and a new higher low. And this trader right now, he could move his stop up to say either day 1 or day 2's lowest low and still be quite safe. And when day 4 rolls around, he could move up his stop to even the low of day 3. He's already so profitable in this trade. He's happy. He knows the market is moving a strong move upward at this point. And this continues on for the next following days until we get what happens here. And this is really key. So when the market makes a new push up, it makes just a slightly new higher high than the day prior. You can see that the top here, the top of the day here is just a little bit lower than the day we're talking about here where the market falls down. So we make a little bit of a higher high, but then all of a sudden, all of the strength of the push upwards in this market starts to evaporate. And the traders with longs see this, and the traders that want shorts in this market see this as well. So they say, hey, we can get a bit of control. What they want to do is they want to break the current pattern of trading and what's been happening, which is every day making a new high and then making a new higher low as well. So every day we're getting a higher high and a higher low on the day as a whole. So you can consider with this the previous day to be a day represent levels of support and resistance in the market. The sellers want to push it down. The sellers don't want to make a new high, and they definitely don't want to make a new higher low. And the buyers are thinking, hey, if we can continue this, if we can make a new high every day and keep the low of the day higher as well, hey, we're still in the clear. We can still keep in control of this upward momentum move. So how does this relate to the high volume spike down? We have to explain this first, and then we're going to go into the high volume spike down. So what happens here on this day is when the market makes the push downwards here, you can see that the market pushed down and the sellers tried to push the market back up. They thought that if we can stall the market right here, okay, we're still good. We've still made technically a higher high on the day, and it'll be a higher low if we can just keep the market above here. But what happens is the sellers come in, they start to push this market down. And then you have to consider every trader who has been trading the strategy from day 1 all the way through to day 1, 2, 3, 4, 5, 6 here, essentially. six full trading days, they could have had their stops at the day prior's at a lowest point, and they would have been safe in and still maintaining their trade. They wouldn't have been stopped out. So that's why this level particularly, so we're looking at, let's clear up this chart a little bit. So all of the traders building up from these previous days may very well have their stop at or slightly below this day's low. So this day is extremely important because up until this day, this pattern has continued. And there are many traders that are piling on trades or have trades that have been going for multiple days in a row, constantly winning. They've been constantly gaining momentum, and it's been going very well for them. So we have to look when the market comes in here and retest it tests it, tries to make a low, it tries to make a low, tries to get pushed back up, and then it actually manages to push down to this level. This high volume spike, not always, but can often be caused by the traders that have their stop loss levels in place. So that's part of the push between the bears and the bulls always. Bears and bulls, this goes identical for trades that are pushing short and then spike up to break levels. The bears and the bulls, the buyers and sellers, are always constantly fighting to push through these levels of resistance and support. And that's one of the things about levels of resistance and support. They're not certain levels. They're just levels that traders are using as reference. So getting back to it, when they're able to push this market through this level of resistance and support that we outlined, all of a sudden, all of the contracts that they have for long trades here, they have their stop losses on these trades. And so as soon as it's able to break through this level, a lot of stop loss levels will be triggered, causing another volume spike down. So you get this volume coming into the market of not actual traders that are saying, hey, I think the market's going down. It's a lot of traders that just are taking profit on what they've made over the last days. That's why it's very hard for a move to only go up for an extended period of time. Because at some point in time, a level of support and resistance is broken. And a lot of traders just want to say, hey, this was a great trade. I held it for 5-6 days. We're going to call it good here and take profit on this trade. So this spike down is a lot of them kind of taking profit on their trade. Similarly, it's a lot of traders that may have entered late into this move and they put their stop loss level at comparable levels, at the previous day's low, in order to kind of follow along with the trend. And they realized at this point that, well, this particular upward momentum move has come to a close. So this is just a breakout of a trend. And you'll see this if you open up your charts and look for these high spikes down when certain areas of resistance and support are tested and then eventually broken through. And that's what ends up causing these higher volume spikes a lot of times, because it's not that there are a lot of traders that are specifically saying the market's going to go down. It's just there's also can be a lot of traders that are saying, hey, this was a winning trade. I'm going to take it and go out of there and get out of the trade. And what this does is open up the market for the sellers who, that want to sell this market short and say, hey, they were able to finally break this strong upward move, and the sellers may now have a chance to be in control of this market and then push it down further. We see another example of that when the market attempts to make a test of the high. They attempt to make a test after a couple days here, or 1 day here, to break up to a new high and are unable to do that. I really like this concept because it gives you an understanding of the market and certain moves, because you're going to see these a lot. I really encourage you to open up your chart and look for these high volume spikes down through levels of resistance and support. And it's an important concept to understand that it's not always, these high volume moves are not always because there's a contention of the price. It may be that just a lot of particular traders just want to take profit on what they've already accomplished in the market over the previous days or hours. And it's one of the reasons that the market is always able to stay in balance. Traders do want to take profits, and traders also want to avoid losses. There's always going to be this cycle between the bears and the bulls being in control. And this is one of the really interesting points on a chart that you can often see. Open this up in your chart and take a look for yourself.